What if I told you that the next financial apocalypse has already been scheduled and the countdown started years ago? What if I told you that hiding beneath the marble floors of the world's most powerful banks lies a weapon of mass financial destruction so colossal that's incomprehensible, that it makes the 2008 crisis look like a minor inconvenience? This is not conspiracy. This is not speculation. This is arithmetic, cold, merciless arithmetic. And by the end of this revelation, you will never look at your bank account the same way again. They call it derivatives, a word designed to sound boring, a word crafted to make your eyes glaze over, a word that protects a $600 trillion shadow lurking in plain sight. To put that number in perspective, the entire gross domestic product of the United States is roughly $27 trillion. The combined value of every stock traded on Wall Street hovers around $50 trillion. Every ounce of gold ever mined in human history. 12 trillion, but derivatives. 600 trillion. Some estimates whisper it could be closer to 1 quadrillion. A number so vast it loses meaning. A number that exists only in the fever dreams of central bankers and the nightmares of those who understand what it represents. Picture this. You walk into your bank, the one with the marble columns, the reassuring logo, the smiling teller who knows your name. You believe your money sits safely in a vault somewhere. You believe the system works. You believe that regulations protect you. But what you don't know, what they desperately hope you never discover, is that your bank is playing Russian roulette with a revolver that has 500 chambers and 500 bullets. The story begins where all great tragedies begin, with hubris, with the arrogant belief that humanity had finally conquered risk. The year was 1994. Wall Street's brightest minds gathered in glass towers, convinced they had invented financial alchemy. They created instruments called credit default swaps, collateralized debt obligations, interest rate derivatives, currency futures, names that sound like spells from an ancient grimoire, names designed to confuse, too obscure to hide the truth from prying eyes. The premise was seductive. Imagine you could insure anything. Your house against fire, your car against theft, your life against death. Now imagine you could insure someone else's house, someone you've never met, against a fire you secretly hope will happen. This is the derivatives market, a casino where you can bet on outcomes you don't control, on assets you don't own, on futures that may never arrive. And unlike a casino, there is no house edge. There are no limits. There are no adults in the room. By the year 2000, the derivatives market had grown to $100 trillion, a number that should have triggered alarm bells, a number that should have summoned regulators. But instead, it triggered champagne corks. Bonuses rained down like confetti. Masters of the universe convinced themselves they had eliminated risk itself. They had created mathematical models that predicted every outcome. They had hired physicists and mathematicians to build algorithms that could see the future. They believed they were gods, but gods have a tendency to forget they're standing on borrowed ground. The first tremor came in 2007, a ripple in the subprime mortgage market. A few homeowners in Cleveland defaulting on loans they never should have received. A minor irritation. A statistical anomaly. The model said everything was fine. The algorithms predicted quick recovery. The executives went back to their 3-martini lunches. But beneath the surface, the derivatives web was already vibrating. Each default triggered a cascade. Each cascade amplified the next. What began as a ripple became a tsunami waiting to be born. March 2008. Bear Stearns collapses in 72 hours. Not weeks. Not months. 72 hours. A bank that had survived the Great Depression, a bank that had weathered world wars and recessions and oil shocks, vaporized in a single weekend. The autopsy revealed the killer derivatives, trillions in exposure that the executives themselves didn't fully understand. Bets piled upon bets. Insurance policies sold to cover insurance policies. A tower of paper promises reaching toward the sky with no foundation beneath it. But Bear Stearns was merely the opening act. The main event was coming. September 15th, 2008. Lehman Brothers files for bankruptcy. The largest bankruptcy in American history. $700 billion, gone. In a single morning, the global financial system suffered a cardiac arrest, Credit markets froze. Banks stopped lending to each other. The mighty engines of capitalism, ground to a halt. And at the center of the wreckage, derivatives. Lehman held over $30 trillion in derivative exposure. 30 trillion more than the gross domestic product of China and Japan combined. And when Lehman fell, every bank on earth felt the shockwave. Here's what they didn't tell you in the news coverage. Here's a secret that still haunts the dreams of Treasury officials. When Lehman collapsed, regulators discovered they had no idea how deep the derivatives web actually went. They couldn't trace the connections. They couldn't identify the exposure. They couldn't tell who owed what to whom. The greatest financial institutions in history were interconnected by invisible threads that no one had bothered to map. It was like discovering that the electrical wiring in your house was done by a blindfolded electrician, using spaghetti instead of copper wire. The response was swift. The response was desperate. The response confirmed everything that critics had feared. The government stepped in with $700 billion of taxpayer money. Banks that had gambled recklessly with derivatives were deemed too big to fail. The moral hazard was established. The message was clear. Take enormous risks. Create incomprehensible instruments. If you win, keep the profits. If you lose, the taxpayer absorbs the devastation. It was socialism for the wealthy, capitalism for the rest. And it planted the seeds for something far worse. But wait, You might be thinking, that was 2008. That was 15 years ago. Surely they fixed the problem. Surely regulations were passed. Surely the system is safer now. And this is where the story takes its darkest turn. This is where the revelation becomes unbearable. Since 2008, the derivatives market has grown, not shrunk, grown from an estimated 500 trillion to over 600 trillion today. The tumor was not removed. It was fed. The time bomb was not diffused. It was given more explosives. The lessons of Lehman were not learned. They were forgotten. Deliberately, systematically, profitably. If this is starting to shift something inside you, If you feel that familiar chill of realization crawling up your spine, then you understand why this matters. You understand why they don't want you watching this. And what comes next will change everything you thought you knew. If you haven't already, subscribe now, because the secrets we're about to reveal are not meant to see the light of day. Let me show you the mechanism. Let me explain how $600 trillion can vanish overnight. Imagine a child's game of dominoes. You line them up carefully. Each domino represents a bank, a hedge fund, a pension system, an insurance company. The dominoes are connected by derivatives, invisible strings of obligation and counter-obligation. When every domino stands, the system appears stable. The models predict perpetual equilibrium. But knock over one domino, Just you one. And watch what happens. This is called systemic risk, the polite term for financial contagion. The sterile phrase that disguises the truth in plain language. It means that when one major player fails, everyone fails. The derivatives web ensures that losses cannot be contained. They spread like wildfire through dry brush. They leap from institution to institution. They cross borders and oceans and time zones. In 1920-9, a market crash in New York took months to affect Europe. In 2008, it took hours in the next crisis, It will take minutes, perhaps seconds. The speed of light, the speed of interconnected computer systems trading derivatives faster than any human can comprehend. Would you trust your future to a system designed to keep you blind? Would you stake your retirement, your children's education, your family's security on a game where the rules are written in a language you're not allowed to understand? These are not rhetorical questions. These are the questions that'll define the next decade. The 5 largest banks in America currently hold derivatives worth over $200 trillion. JP Morgan Chase alone holds over $50 trillion. That's more than twice the gross domestic product of the United States. One bank holding paper promises that dwarf the real economy. And here's the terrifying detail. These positions are marked to model, not marked to market. What does that mean? It means the banks get to decide what their derivatives are worth. They use their own mathematical models to calculate value. They grade their own homework. They determine their own health. And they always, always, always give themselves a passing grade until they don't. The Volcker Rule was supposed to fix this. Dodd-Frank was supposed to prevent it. The Basel Accords were supposed to contain it. But derivatives have a remarkable ability to evolve, to mutate, to find new dark corners where regulations cannot reach. For every rule passed in Washington, 10 new instruments are invented on Wall Street. For every door closed, 1,000 windows are opened. The game continues, the casino never sleeps, and the bets grow larger by the day. Consider interest rate derivatives, the largest category in the derivatives universe. When interest rates move, these instruments move with them. Banks use them to hedge exposure. Corporations use them to manage debt. On the surface, they seem prudent, responsible, even boring. But here's what happens when rates move unexpectedly. In March 2023, a modest rate increase by the Federal Reserve triggered the collapse of Silicon Valley Bank, the 16th largest bank in America, gone in 48 hours. Depositors lined up around the block. Social media accelerated the panic. And at the heart of the failure, interest rate exposure that no one had properly monitored. Silicon Valley Bank was not unique. It was typical across the banking system. Hidden exposure lurks in the shadows. Duration mismatches, concentration risks, counterparty failures, the vocabulary of catastrophe waiting to enter common language. And floating above it all, 600 trillion in derivatives that could accelerate any crisis into an extinction-level event. What would you do if you discovered the game was rigged from the start? What choices remain when the foundation beneath your feet is made of sand? The Federal Reserve knows. They've run the simulations, they've stress-tested the scenarios, they've gamed out the possibilities, and in private meetings, behind closed doors, they admit what they cannot say publicly. The next crisis will require interventions that make 2008 look trivial. The next bailout will not be 700 billion. It will be 7 trillion. Perhaps 70 trillion. Perhaps numbers that don't yet have names. The printing presses will run until they melt. The inflation that follows will reshape society and ordinary people. People who played by the rules. People who saved and sacrificed and believed the promises will pay the ultimate price. But here's the secret within the secret. The revelation behind the revelation. The crisis is not a possibility. It is a certainty. The only unknowns are timing and trigger. Will it be a sovereign default? A major bank failure? A cyber attack on the financial infrastructure? A geopolitical shock? A pandemic worse than what we've already survived? The specific cause matters less than the underlying truth. $600 trillion in derivatives cannot be unwound gracefully. The positions are too large. The connections are too complex. The leverage is too extreme. When the dominoes start falling, there will be no time for orderly resolution. There will only be chaos. The insiders understand this. The billionaires who don't appear in headlines, the family offices that manage generational wealth, the sovereign funds of nations preparing for what comes next, they are already positioning, they are buying hard assets. Gold, land, commodities, anything that cannot be printed, anything that cannot be deleted by a keystroke. They are building bunkers, not just physical bunkers in New Zealand, but financial bunkers designed to survive the storm. And they are doing this quietly, without fanfare, without alerting the passengers that the ship is taking on water. Is it still possible to escape? Can you protect yourself when the architects of destruction control the game? History offers uncomfortable lessons. In 1920-3... Germany experienced hyperinflation that destroyed the middle class overnight. People who had saved their entire lives, professionals and merchants and factory workers, watched their savings become worthless. They burned currency for heat because firewood was more expensive. They carried wheelbarrows of cash to buy bread, and in that chaos, fortunes were made by those who understood what was happening. Real estate was purchased for pennies. Businesses were acquired for fractions of their value. The transfer of wealth from the unprepared to the prepared was total and merciless. In 1990-8, Russia defaulted on its debt. The ruble collapsed 90%. Pensioners who had trusted the system found themselves destitute. Oligarchs who had positioned correctly became billionaires. The pattern repeated in 2001. Argentina froze bank accounts overnight. Citizens watched helplessly as their savings were seized. The social contract shattered. Trust in institutions evaporated, and a generation learned that the promises of the financial system were written in disappearing ink. These are not isolated incidents. These are the historical norm. Fiat currencies fail, derivatives accelerate the failure, and those who refuse to see the pattern are condemned to become its victims. What separates the survivors from the casualties? Knowledge, awareness, the willingness to look directly at uncomfortable truths, the courage to question narratives written by those who profit from your ignorance, the wisdom to prepare while preparation is still possible. The derivatives bomb ticks silently in the basement of the global economy. Every day you ignore it. Every day you assume someone else is handling the problem. Every day you trust that the system will protect you. Is a day closer to detonation. The countdown cannot be stopped. But your response to it, your preparation for it, your understanding of it, is entirely within your control. They have spent decades building a system designed to transfer wealth from the many to the few. They have created instruments so complex that even their creators don't fully understand them. They have captured regulators and purchased politicians and silenced critics. They have convinced you that this is normal, that this is necessary, that questioning the system is the province of conspiracy theorists and malcontents. But the numbers don't lie. $600 trillion, a weapon of mass financial destruction. Waiting, the question is no longer whether the bomb will explode. The question is whether you will be standing beneath it when it does. The question is whether you will have taken steps to protect yourself and your family. The question is whether this revelation will fade from your memory like all the other warnings you've received, or whether it will ignite something within you. A determination, a resolve, a refusal to be a passive victim of what's coming. They're counting on your apathy. They are betting on your distraction. They're gambling that entertainment and consumption and the endless scroll of digital noise will keep you sedated until it is too late. But you're still here. You've listened this far. You've allowed yourself to see what they've hidden in plain sight. Now the choice is yours. If this has opened your eyes, if you can feel the weight of what we've revealed, imagine what we're preparing to expose in our next episode. A secret buried even deeper. A truth even more dangerous. A revelation that will shake the foundations of everything you think you understand about wealth and power and the hidden hands that move the world. The Vault of Secrets has many chambers, and we're just getting started. Subscribe now, share this with someone who needs to see it, and prepare yourself. Because once you step through this door, there's no going back. The countdown continues. The clock is ticking. And $600 trillion waits in the darkness, patient as death itself.